Is life insurance an investment? Period. Welcome to the Shakaama Live Show with your host, Shakaama. When it comes to considering life insurance as an investment, you've probably heard the adage, quote, buy term and invest the difference. This advice is based on the idea that term life insurance is the best choice for most individuals because it is the least expensive type of life insurance and leaves money free for other investment. Permanent life insurance, the other major category of life insurance, allows policyholders to accumulate cash value, while term does not. But there are expensive management fees and agent commissions associated with permanent policies. And many financial advisors consider these charges a waste of money. When you hear financial advisors and more often life insurance agents advocating for life insurance as an investment, they're referring to the cash value component of permanent life insurance and the ways you can invest and borrow this money. When does it make sense to invest in life insurance this way? And when are you better off buying term and investing the difference? Let's take a look at some of the most popular arguments in favor of investing in permanent life insurance and how other investment possibilities compare. Now, before I begin into going into which is a good argument for permanent life insurance being an investment grade paper, I want to point out that regardless of the quote adage that buy term life insurance and invest in the difference, the behavior of the majority of the United States of Americans is that they will never, ever invest the difference. They will always find a reason to buy or spend the money left over from any sort of term life insurance. They're never going to take the half that they're not spending in life insurance and buy actual investment grade paper. Let's continue. There are many arguments in favor of using permanent life insurance as an investment. The issue is these benefits aren't unique to permanent life insurance. You often could get them in other ways without paying the high management expenses and agent commissions that come with permanent life insurance. Let's examine a few. Number one, you get your tax deferred growth. This benefit of cash value component of permanent life insurance policy means you don't pay taxes on an interest, dividends, or capital gains in your life insurance policy until you withdraw the proceeds. You can get this same benefit, however, by putting your money in a number of retirement accounts, including traditional IRAs, 401ks, 403bs, simple IRAs, SEP IRAs, and self-employed 401k plans. If you're maxing out your contributions to these accounts year after year, permanent life insurance might have a plan in your portfolio and could provide some tax advantages. Once again, I will rehash that it requires for you to do the investments into your IRA, 401ks, 403bs, simple IRAs, SEP IRAs, and self-employed 401k plans yourself. Number two, you can keep your policy until age 100 as long as you pay the premiums. A key advertised benefit of permanent life insurance over term life insurance is you don't lose your coverage after a set of number of years. A term policy ends when you reach the end of your term, which for many policyholders is at age 65 or 70. But the time you're 100, who will need your death benefit? Most likely, the people you originally took out a life insurance policy to protect, your spouse and children, are either self-sufficient or have also passed away. And let me just rehash something in number two. Term life insurance ends at age 60 or 65 or something like that, right? After that term is over, you have no life insurance. The permanent life insurance ends at age 100, so that anytime from 60 to 100, you're going to be benefiting if you have the permanent life insurance. The problem is you have to have the permanent life insurance from when you were 30 or 40. You can't then elect to get permanent life insurance after you've had term and life insurance that the entire time. Number three, you can borrow against the cash value to buy a house or send your kids to college without paying taxes or penalties. You can also use money you put into a savings account, one on which you don't pay fees and commissions, to buy a house or send your kids to college. But what insurance agents really mean when they make this point is if you pay money into a tax advantage retirement plan like 401k and want to take it out for purposes other than retirement, you might have to pay a 10% early distribution penalty plus the income taxes that's due. Further, retirement plans like 457Bs make it difficult or even impossible to take out money for one of these purposes. That being said, it's generally a bad idea to jeopardize your retirement by raiding your retirement savings for some other purposes, penalties or not. It's also a bad idea to confuse life insurance with a savings account. What's more, when you borrow money from your permanent insurance policy, it will accrue interest until you repay it. And if you die before repaying the loan, your heirs will receive a smaller death benefit. Now, let me say this. I want to pound on that point also. I had to cash out my 401k, of course, in 2008. Of course, you're going to pay all sorts of penalties and then taxes and everything is set against you. The whole idea is the benefit of the 401k is that you're getting all sorts of tax deferments and what have you that will benefit Wall Street. So they made it very advantageous for you to take out a 401k and invest in your 401k for your retirement. I'm not saying it's a terrible plan, 401k. I'm saying the advantage really doesn't advantage you. And if you do have to use money that you've been setting aside and it has to come out of your 401k, it's going to disadvantage you very heavily. Number 4, permanent life insurance can provide accelerated benefits if you become critically or terminally ill. You may be able to receive anywhere from 25 to 100% of your permanent life insurance policy's death benefit before you die if you develop a specified condition such as a heart attack, stroke, invasive cancer, or end-stage renal failure. The upside of accelerated benefits is you can use them to pay your medical bills and possibly enjoy a better quality of life in your final months. The drawback is your beneficiaries won't receive the full benefit you intended when you took out the policy. Also, your health insurance might already provide sufficient coverage for your medical bills if you have a Cadillac insurance. I'm sorry for digressing there. In addition, some term policies offer this feature. It isn't unique to permanent life insurance, though. Some policies charge extra for accelerated benefits too, as if permanent life insurance premiums weren't already high enough. So this is a little bit convoluted, and let me break it down for you. You can receive your entire permanent life insurance if you develop one of the specified ailments, illnesses, heart attack, stroke, cancer, or end-stage renal failure. You can receive all of your permanent life insurance paid back to you without penalty. Of course, if you take 100% of your permanent life insurance away, that means 100% of it will be gone. However, if you're looking at something that is drastically expensive as far as like cancer or stuff like that, and the medical bills are piling up and you have to pay $30,000, as much as your home costs, of course, the best thing to do is to have something like this in place. Term life insurance does not have this, period. So for all of you all who are on the poorer scale, and this is why you're taking out term life insurance, you don't have this as a benefit. It's not an option to you at all. So then you have to say, okay, is everybody in my family getting cancer? Maybe I should take out permanent life insurance instead of term life insurance. It's not an option for term life insurance. Have you invested into, and if you do the 401k, then you're going to suffer all the penalties of withdrawing for 401k. You'll have to look up and see, is 401k have any specified excuses? Now, here are the arguments in favor of buying term insurance and investing the difference. This, of course, means that you are of the mind and you don't live in Vegas and you're not gambling every paycheck which all of my neighbors do, all of them, every single one of them. That's why they're living in the trailer park, probably. I'm passing judgment. They're not here to defend themselves. I can talk about them now, right? If you have behavior that is not conducive to investing, then I don't recommend term life insurance at all. At all, not even a little bit. And if you are on the poorer side of the scale, I'm recommending you get the more expensive permanent life insurance. Why? Because then that sets in place something that automatically accrues cash, and it's going to benefit your loved ones exactly how it's supposed to benefit them. When you die, there is a payout, regardless of your age, unless you live beyond 100. And for the most part, most humans do not live to see 100 or more than 100. Here we go. When you buy term policy, all of your premiums go towards security, a death benefit for your beneficiaries. Term life insurance, unlike permanent life insurance, does not have any cash value and therefore does not have any investment component. However, you can think of term life insurance as an investment in the sense you are paying relatively little premiums in exchange for a relatively large death benefit. What's the problem now? In 2018, what's the problem now? People live beyond the age of 60. More and more people are living beyond the age 60. The life expectancy going down does not mean that more people aren't living beyond the age 60. That was never the deal. Even when they're talking about people used to have a life expectancy of 16 years old, what was the real stat there? The real stat was there was a lot of infants passing away. A lot. Tons and tons. If you made it to past 5 years old, more than likely you were going to live to see age 60. How's that for reversing all of the information that you were taught in school, talking about during the Bible days, people, or even during early pilgrims in the United States, that they only lived to see age 16 or something like that? For example, a non smoking 30-year-old woman in excellent health might be able to get a 20-year term policy with a death benefit of $1 million for $480 a year. If this woman dies at age 49 after paying premiums for 19 years, her beneficiaries will receive $1 million tax-free when she paid in just $9,120. Term life insurance provides an incomparable return on investment should your beneficiary ever have to use it. That being said, it provides a negative return on investment if you are among the majority of policyholders whose beneficiaries never file a claim. In that case, you will have paid a relatively low price for a peace of mind, and you can celebrate the fact you're still alive. Let's hunker down on that. Let's expand that there. So they said right out the gate, a majority of the beneficiaries of the people who are getting term life insurance never get to cash out the term life insurance. Why? Because they live beyond the age of 60 or 65 or whatever their term is. In fact, I did not know that there was a term to 70 years old. In fact, most terms that I have seen is 63 years of age. After 63, it ends. That's the end of the term. You cannot renew. So most people are paying $480 a year and never, ever get to see any of that money. That's term life insurance. Keep going. Do you really hate the idea of potentially throwing away almost $10,000 over the next 20 years? What would happen if you invested $480 per year in the stock market instead? If you earned an average annual return of 8%, you'd have $25,960 after 20 years, before taxes and inflation. Considering the opportunity cost of putting that $480 per year into term life insurance premiums instead of investing it, you're really throwing away $25,960. But if you die without life insurance during those 20 years, you'll leave your heirs with almost nothing instead of the $1 million. Okay, so what they're saying is, if you did not buy term life insurance at all, you invested that 480 into the stock exchange, and let's say you do live 20 years or 30, I don't know what they're 20 years, you're buying a term for 20 years for $1 million. Thank you. You are actually going to receive 25,960. Now, this goes into understanding investment and time and money. Time plus money equals end result. The end result is you would ordinarily receive $25,960. If you live to age 60 and you never recouped on that life insurance term policy, you would have lost $10,000 over the 20-year period. For this scenario, you're only 50 years old. Do you think you can live to age 50? Most of you listening to me are age 50, so you know that was a bum deal. But here's what you have to actually calculate. Had you been smart at age 30, invested into the stock market with a modicum return of 8%, you actually would have lost 25,960 if you had invested in term life insurance and lived to see age 50 and a day. So it's not $10,000 that you lost, that you threw away. It's actually $25,960 that you threw away. They say the alternative is, had you got the term life insurance and you only lived to age 49 and you died, your beneficiaries would have seen $1 million. Well, that might be true. Have you been taking listening to my courses and tutorials on investing? You know that more than likely you would have had $1 million anyway, if not 2 or 3 or 4. Why? Because I'm talking about dividend reinvestment programs where you keep buying stock in a specific company, and every time they have a dividend, you rebuy more stock, so that over the course of 20 years, more than likely, you're going to have $4 million sitting on hand. Oh, you haven't taken a look at that? Look at my investment series. It's a series. It's one of my playlists. Moving on, what if you bought permanent life insurance instead? The same woman described above who purchased a whole life insurance policy for the same insurance company could expect to pay $9,370 annually. The whole life policy cost for the single year is just slightly less than the term life policy for 20 years. So, how much cash value are you building up for that extra cost? After 5 years, the policy guaranteed cash value of $19,880, and you will have paid $46,850 in premiums. After 10 years, the policy's guaranteed cash value of $65,630, and you will have paid $93,700 in premiums. After 20 years, the policy guaranteed cash value is $181,630, and you will have paid $187,400 in premiums. But after 20 years, if you had bought the term for $480 a year and invested the $8,890 difference, you'd have $480,806 before taxes and inflation at an average annual return of 8%. So they're saying if you had bought the the permanent life insurance, you would have only had a cash value of $181,630,000, but if you had the term and invested the rest, or not even at the term, I believe. No, they're saying they're investing the difference. So you bought the term and you invested the rest, you would have had a cash value of $480,806. That's if you had invested it for 20 years. I ask all of you, do you have a savings account, and do you have nearly $500,000 in it if you're age 50 right now? Talk to me. Sure, you say, but the permanent life insurance policy guarantees that return. I'm not guaranteed an 8% return on the stock market. Of course you're not. That's true. If you have no tolerance for risk, you can put the extra $8,890 a year in a savings account. You'll earn 1% annually, assuming interest rates never go up from today's historic lows. After 20 years, you'll have $208,671. That's still more than a permanent policy guaranteed cash value of $181,630. What's the problem with the scenario? The problem with the scenario is if you put it in a bank into a savings account, even at 1%, what's going to happen when Junior wants a bike? Now he wants a turtle. Now he wants little Missy wants a horse. You got your clarinet club, you got your glee club, you got your field trip, you got your foreign exchange payments that you got to pay. You're going to be dipping into that savings account. You're not going to end up with $208,671. I ask, how many of you 50-year-olds listening to me now have $250,000 in savings? Here's the bottom line. Using permanent life insurance as an investment might make sense for some people in some situations. Usually high net worth individuals looking for a way to minimize estate taxes. For the average person, the odds are poor that permanent life insurance will be a good investment compared with buying term and investment. Just so we understand, as you pay your permanent life insurance, you are actually accruing cash value for the permanent life insurance. So they said after 20 years, your uh, will average 400. I'm sorry, after you will average 181,630. You would have paid in 187,400. Now, this is all tax free. There's no taxes on it. There's no this. There's no that. It's all. These are all benefits to the insurance company, but the benefit is passed on to you, of course, right? There's no taxes. Now, is there taxes on you generating $480,000 at 8% on the stock market? Yes. Oh, it's 15%. So slash 15% off of that. If you die, slash the estate tax off of that, slash the give tax off tax, slash all the tax. You probably end up 181,000 anyway. Let's be real here. All right, there we go. Thank you all for watching. Thumbs up this video. Thumbs up this video very much. Okay, I need your support. I'm doing this video because the advertisers that are giving me are the cheap advertisers. I need to get back to the upper end of advertisers. Thank you so much. You didn't hear that from me because I ain't one to gossip. Share this, subscribe, leave all sorts of comments, ask all the questions you can. I'll come back to this anytime I go. I love your comments, okay? So go ahead, ask all the questions you want.